please help us understand in short, in the next 2-3 slides, what is a par product or a participating product, and how is it slightly better than the other two that we've discussed?
Sure. So there, if you look, there are investors who are very much equity savvy, and who, when in, let's say for example on 25th March, when Sensex bottomed out at 25,000, many people were still fearing, and they were doing a panic selling. And if you look, Sensex majorly fall from 40,000 to 25,000 levels because major of the foreign institutional investors moved out their money. But if you look data, or if you look, the net inflow in the month of March by domestic institutional investors was 55,000 crore. So the people are there who look who see even when the market falls, they see opportunity and they grab the opportunity. So in a par product, here you can enjoy best of the both the worlds. Here you get the benefit of equity, as well you get the benefit of debt. So in equity here, because as we all know, equity is the only instrument which has a, a higher chances or a better potential to beat inflation and generate a better return in a longer term horizon. So here a customer bears the risk, his returns are affected by volatility and has higher long term returns. Whereas on the debt side, you are getting a constant return, there's a capital guarantee and a very less risk. So an individual is always in a dilemma: should I invest into equity or should I invest into debt? So as an ICICI Prudential, we just came up with a product known as a Future Perfect, where it's a blend of both. So here you're getting chances of higher return as well as a capital safety. So both, the best of both the worlds, are combined into one product. So if you look at the the payout structure, and Future Perfect, there is a guaranteed maturity benefit, there is a guaranteed addition, there is a revisionary bonus and a terminal bonus. So here from a day one, there is a guaranteed addition on the policy which has been happening, and there's a guaranteed maturity benefit. So this guaranteed addition and a guaranteed maturity benefit safeguard your capital. So for example, if I invest 10 lakhs, I know that minimum I will get 12 lakh rupees. So there's a capital guarantee by a debt side and a higher return chances because of the revisionary and the terminal bonuses which I will get because of the equity investment. So Future Perfect is a blend of yeah.
For the benefit of the viewers, and since a lot of questions have been asked on my WhatsApp chat, can you hear me, guys?
No, sir. We are not hearing properly.
Now can you hear me?
Sir, yes. Is
this better? Thank you. Thank you, Anil bhai.
Yeah.
So, Himmat, I will just pause you here for the benefit of the viewers. You are saying that the participatory par products will participate in equity in a controlled way. But now let's focus on this slide on the bonuses and how it grows. So what we see as GMB is something which is fixed at the beginning of the plan, you're saying?
Yes, it is fixed.
Okay. And then every year this RB, the reversionary bonus RB 1, 2, 3, 4 keeps getting added to the policy amount. And in the end, the yellow terminal bonus is something extra. So there are 3 different components, which finally, if you see the last at the end of the plan bar, you have a GMB plus the total gray reversionary bonuses and a terminal. That is the total return of the plan. Is that correct?
Yes, completely.
Okay, fantastic. Sorry, let's move on.
Yeah. So here, Future Perfect is a blend of equity plus debt, where if you look, the guaranteed benefits, where as I said, the guaranteed maturity benefit is from the beginning of the plan, and guaranteed death benefit and guaranteed addition. So this is a safeguarded that, yeah, my capital protection is 100% capital protection. So there is no downside for it. Whereas the bonuses part is such as revisionary and terminal bonuses, it will be very much higher, and both combined is your maturity benefit. So here a client or an individual is getting a blend of both equity as well as debt, with capital protection as a paramount factor and a better return because there is a equity component in the product. So it's a very good proposition for someone as your client who is very, who is equity savvy, but he's not so much aggressive into equity. He also always want to go for a balanced approach. So for that balanced approach, Future Perfect is a beautiful proposition.
I think you hit the nail when you said balance. I was just going to say that I've had experiences with, certain mutual funds and balance funds. This is all what, I'm sure the audience also is aware of. So this in effect is a tax-free balance fund with a capital guarantee and a life cover. And in a very steady manner, part of the bonuses are guaranteed, part of it is left as an upside, and we all know the benefits of long-term equity investing. If you had bought let's say Hindustan Lever 10 years ago as a stock, or Reliance or Tata Consultancy, these blue chips, we know how far they have gone up today. And most of us end up, holding bank deposits. So I think very fair and a very, very well summarized point on the returns part and the way it is structured. Any questions on this? We will probably leave it to the end of the session.
Yeah. So, like we already did for ASIP as compared to FDs, Lakshya Lifelong Income as compared to FD, and let's do the Future Perfect as compared to FDs. So here in Future Perfect, there's a capital guarantee, there is equity exposure, so there is a higher alpha we can generate over the period of time. There's a consistent long-term returns which has been generated with we have a historical data. There's a tax-free return and a protection with the life cover. So you're getting a life cover in all our products from the day one. So it's like a safety cushion or a safety net for an individual. So it's a very good proposition, and as rightly mentioned by you, equity, if you, for example, in 2010, if I invested 100 rupees in Bajaj Finance, today it will be around 9600 rupees. So I'm just 1 lakh rupees is around 96 lakh rupees in just a 10-year horizon. So this is the power of compounding or a power of equity. But equity always comes with a risk. So if there is a high risk, high return. So that's why for a client who is always skeptical in the mind that I should reduce my equity exposure over the period of time, or I should go for a balanced approach because I do not want to extend my goals timeline. So HR Perfect is a beautiful blend of equity plus debt. Whereas a fixed deposit, there is a reinvestment risk. There is no capital guarantee. As I said, there is a huge amount of NPAs, like we heard of the PMC bank case, where depositors were, literally begging for their deposits. And even, I just want to quote an example that last year, because of the NBFC crisis, even banks started putting stamps on FD that minimum guarantee is only 1 lakh rupees. The minimum they started putting the stamps. So here even your FDs are not secured. There's no capital guarantee. There's no equity exposure. So there's no upside. The consistent returns are also a big question mark because there's a reinvestment risk and the taxable maturity as per your income tax slab. So it's a very beautiful proposition. And a Future Perfect, as if you look Future Perfect composition, is in Future Perfect 60% is debt investment and 40% is an equity investment. So here a 40% exposure into equity exposure is a very good proposition, and I want to reiterate why ICICI Prudential Future Perfect is the best traditional plan in the industry is because of its transparency. If you look in transparency, none of the traditional products disclose their portfolio. So what is their holding, what is their underlyings, and in today's time, all the investors are very much savvy कि मेरा पैसा कहाँ invest हो रहा है. So ICICI Prudential Future Perfect plan, if you go on our website, you get a complete detailed portfolio holdings of ICICI Prudential Future Perfect, which is a traditional plan. Whereas on the traditional plan, IRDA does not say that you need to mandatory show it. But as I said, ICICI Prudential always focus on safety, stability, and visibility. In the visibility perspective, we have completely shown our portfolio on the website. Whereas other, traditional products do not highlight the portfolio. So it's a good part. Whereas here, if you look what does Future Perfect offer, it's a higher return chances because of the 40% of equity participation. There's a comfort of a capital guarantee because of the 60% debt part. There's a life cover for the entire policy term and a tax benefit which are already, a part and parcel of a life insurance product, such as because of the section 80C, where you pay the premium, you get a benefit of 1.5 lakhs, and all the maturity are tax free because of section 1010D. So it's a beautiful proposition for someone with a client who wants.
I would also like to add here, Himmat, and probably you summed up well in terms of the credit crisis. See, so far, I think as investors, we were quite happy putting money in banks or in fixed deposits of companies. A lot of us also did get carried away with a little greed, and we put money in papers like DHFL or ILFS. We were not aware that a DHFL will go bust, or there will be some kind of a fraud or a misallocation of capital, and our funds will be stuck. I think the investors also sentiment was further scarred when ILFS had issues of repayment. There was no fraud, but there is a liquidity crisis out there, and so on and so forth with many debt funds, including the latest Jolt. Where a very reputed brand, Franklin, came out and said that we cannot, we are going to delay and we will not allow redemption. So I think a lot of investor faith, as it was shaken in the scam days in the stock markets 25-30 years ago, similar kind of small jhatkas are coming up in the debt market. And what we thought was peace of mind products, unfortunately, I know clients who have got stuck with lots of large amounts in all these papers. And today, not only are they not getting interest, but they're also not getting any visibility on return of capital. So I think your point that you made in terms of safety of capital guarantee is very, very important, and that in a balanced manner. So quickly moving on, probably we will just take one question. Quite a few questions coming up on, we did see the structure on guaranteed plus, reversionary bonuses. So can you just throw a little more granular light on what kind of policy structure this has, Future Perfect, and what are the guaranteed additions? And then we will also move on to the bonus track record in terms of annual bonus which you have had, because ICICI Prudential has been for a long time and you have a track record.
Sure. So yeah, if you look the product, feature or product components, yes, there's a policy year of 5 pay, 7 pay, 10 pay, 15 pay, 20 pay. So the more you stay, the more benefited you are, because the compounding power of equity comes into the play. But if you look on the guaranteed addition side, from 1st to 5 years in a 5 pay, 7 pay, there's a guaranteed addition of 8%. So there's a guaranteed addition of 8% from the first year itself. From 6th to 10th year, there's a guaranteed addition amount percentage rises to 10%, then further to 12%, and further to 15%. So the more you stay, the guaranteed additions keep on adding up in a huge manner, and that too in a compounding fashion. And whereas equity also starts playing its important role, because in the longer run, then returns get normalized. So it's a good part where guaranteed addition also increases with the time, and the equity component also increases with the time. So yeah, it's you can see in the chart where the four important components are: guaranteed maturity benefit, guaranteed additions, revisionary terminal bonus. Everything are there. So the terminal bonus will give you the higher return, that a higher alpha which we are expecting. And this guaranteed addition and guaranteed maturity benefit are the safety cushion for the capital guarantee, capital protection, and everything. So it's a good. Yeah, and the tax benefit, as rightly mentioned, it's completely all the maturity are tax free. Now, as an investor, in today's time, if I've seen so much cycles, for example, in 2008 Lehman Brothers crisis, in 2013 where Fed tapered the interest rates, in 2016 when there was an NBFC crisis, and in 2018 when there is 2020 when there is a COVID type of crisis. So the investors are now very skeptical where to invest. I should need to look at the fact sheet, who is the fund manager, what is the historical data. So here ICICI Prudential has a very big edge on it, because we have a huge track record and historical data of 20 years, because we were the first private insurance company to be listed on stock exchange. And just to add to a point, ICICI Prudential is the longest running joint venture in an insurance industry. So if you look at the historical data, or all of our traditional products, we have what we have committed, we have delivered that type of bonuses. If we look from 2014, 15 to 2020, whatever we have committed, we have declared not just at the same level, but we have declared higher bonuses for all our policy holders. And in 2020, when in type of such COVID crisis, when all the major industry and sectors are taking a big hit in the terms of their revenue, many company has not started, they did not declare the bonuses. But ICICI Prudential, as we say, customer is the king. We are a consumer centric company. All our products are consumer driven, so we declared the bonuses even in 2020, and that too all are fullest. We did not even reduce the percentage by any 25 or 10 basis point also. So it's a very good proposition for the client, which gives him that sense of confidence. Yeah, so I'm investing into a good product with a good historical data and with everything.
I think it's a very important point, and just like to reiterate that whatever we see as reversionary bonus, leaving aside the terminology, reversionary bonus means that bonus which comes to you in the event of profits that the fund or the scheme makes. And it is wise fund management probably, where that means there are enough profits tucked away in the past, which has allowed declaration of bonuses across all the traditional savings plans, even a difficult year, which the fund managers at IPRU have demonstrated. So please accept my hearty congratulations on that prudence, and also the fact that you have maintained the investor faith.